So this graph here, this pie chart here shows uh, the total amount of assets that are held by different types of investment companies that we have discussed. So you have mutual funds making the bulk of all the investments. Exchange traded funds are the next biggest one here, and as I mentioned before, they are increasing their share here, and the other two closed-end funds and unit investment trusts are on a decline. Basically, whatever you can achieve with closed-end funds and unit investment trusts, you can now accomplish with mutual funds and ETFs. Uh, the most of the retirement plans like 401k plans and all actually have mutual funds and not ETFs, and that's the reason why mutual funds have such a big share of the overall pie here. And this one is a little bit dated 2010, but the overall picture still remains the same. Mutual funds are still the most popular uh, investment vehicles for these type of pooled investment companies. So we have talked about mutual fund performance before, but I want to revisit that, talk about some other aspects of mutual fund performance. As you know, the overall evidence regarding the performance of actively managed mutual funds suggests that the performance is quite disappointing. Majority of these funds are not able to beat their benchmarks. They are not able to beat the market. There is some weak evidence of persistence in performance, but that's not very convincing. So here in this graph, what you are seeing is basically a comparison of the average returns of a stock mutual fund versus Wilshire 5000 index. So Wilshire 5000 is the broadest US market index. It includes all the publicly traded companies on major indexes. So unlike S&P 500, which is only basically large cap, Wilshire 5000 includes companies of all different sizes, small and big. So it is a broader index, and therefore that is the one that is used here for comparison. So average return of a stock mutual fund versus Wilshire 5000 annually is starting in 1971, and this goes to 2010. The blue lines are the stock fund, and the red lines are the Wilshire 5000 index. And Wilshire 5000, by the way, is investable. There are actually investment products, mutual funds, and ETFs that track Wilshire 5000. You get exposure to the entire US market basically through these funds. So this is not something that is hypothetical. You could have achieved similar performance. At least you can do it these days. But what this comparison here is showing is that in most of the years over this 40-year period, the Wilshire 5000 was actually ahead of an average stock mutual fund. The red bars are bigger here on the positive side. So the basically what that means is that Wilshire 5000 in most years has actually outperformed a stock mutual fund on average, right? So that is consistent with what we have discussed before. Now, talking about consistency in performance, right? So uh, there are a number of different ways in which people have sort of studied performance persistence. So the idea behind performance persistence is that one time good performance might be due to luck, but if a fund is able to deliver superior performance repeatedly, then perhaps there is some skill involved, right? So it goes back to that luck versus skill issue in performance studies. So this is an older study doing performance persistence sort of evaluation. So basically, the idea is that you divide the funds in any given year into two groups, like the top 50% funds based on their performance and the bottom 50%, right? So two groups, the top performing and the bottom performing, right? So if you have say 100 funds, you would classify top 50 into the the good performing group, and then the bottom 50 into the bad performing group. And then what you do in the following year is you evaluate the performance of these funds again. And if the ones that were in the top 50 in one year, if they were in the top 50 group purely due to luck, then what we would expect is that half of those, so 25 of those 50, would continue to stay in that top group, but other 25 would actually end up in the bottom group, right? And similarly for the bottom 50, you would see 25 transitioning into the top group, and then 25 remaining into the bottom group, right? So if it's purely by chance, we'll basically see this 50% numbers all around, right? So here is top half in one group, how many of that remain in the top half in the next year, right? That is the idea. So if you look at the evidence here from the 70s, right, the evidence in the 70s, that evidence is actually consistent with some performance persistence. Of the funds in the top half in one year, 65% actually continue to be in the top half in the next year, and similarly for the bottom half, 65 continue to be in the bottom half, 65%, right? So good performance seems to persist, bad performance seems to persist. So that is consistent with performance persistence. But when you go to the 80s, it's basically all 50% all around, right? I mean, these numbers are all close to 50%. It's basically saying that there's no performance persistence. It's purely by chance that half the ones that are in top group are in top group due to luck, and similarly for the bottom group. So uh, it's perhaps the case that markets have become more efficient over time. So this is more sort of relevant for current times, that it is actually harder to outperform the market in more recent years, right? So that is essentially what we can glean from this evidence here. All right, so there are some issues here like survivorship bias and things like that. Like if I have 100 funds and I divide them into 50 and 50, the lowest five of those, right, the worst performers are likely to go out of business. So that is like you're only looking at 95 out of 100 in the next year, and you have to account for that fact in these type of studies. So there is some survivorship bias and those kind of things that you need to be aware of, right? But that is generally the overall evidence that mutual fund performance hasn't been that great over the years, and that has resulted in a shift towards index investing. So on this last slide, I have listed some sources for information about mutual funds. Morningstar is a very comprehensive source of mutual fund information. A lot of information is subscription based, but you can actually get a lot of information for free as well. And then of course you can look at fund prospectuses, I mentioned this before, and then standard sources of information, Yahoo Finance, Wall Street Journal, and things like that. Okay, so that concludes our discussion on mutual funds. Feel free to ask any questions related to this material on our Zoom office hours or through email.